With over $35 trillion in home equity, should the American consumer be turning to all of the wealth sitting in their home to create a better path to financial freedom? As a loan originator, how can and how should you be leveraging HELOCs and HELOANs to be the best advisor to your client and the community you serve? In today's episode, we are going to do a deep dive into HELOCs, HELOANs, tapping into equity, and how strategically lenders and homeowners can work together to improve their financial situation with leveraging the wealth that sits inside of their home. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what's popping?
John, I'm actually remembering that time in my life where a home equity line of credit that I took out from AmSouth Bank, that's not even around anymore. I think they were taken over by Regions.
Yep.
But how it was life-changing to a young 20-something-year-old professional who had only made one good decision in his entire adult life, and that was to purchase a house.
Well, I get excited about these HELOC episodes because you teach me strategies and tactics of how I can use my home like a credit card and just go bonanzas at the mall.
I'm going to teach you how to leverage the wealth that you have accumulated because you own real estate.
And buy things I don't need.
To better your overall financial outlook.
Damn.
I mean, look, you can do the what not to do.
Let's start with that.
We call that the JC way.
That's like, can we please start an episode of this is what, not just skip all the bullshit. We'll get to today's sponsor. We're going to get to all the like the juicy nuggets, but please, can we start this episode? What not to do. What not to do. Using your home like an ATM machine is not necessarily advisable. Why? Because just like you explained to me, I have to pay myself back, so I can just pay myself back with interest or something. Isn't that how it works?
I mean, look, it does, but isn't the purpose of purchasing a home to generate wealth? That would be like, John, you investing in your 401k. Oh, shit, you may have done this already.
Yeah, watch your mouth where you finish this.
And then cashing it out to build a home gym.
Yeah,
cashing it out to buy a sauna.
That's not what it's for.
Cashing it out to get custom-made golf clubs. Fuck. I mean, look, you can do that. I just hope you have another way to survive.
No, I'm fucking rolling Yahtzee on TLOP.
You're
TLOP or bust, man. I swear to God.
Either that or you're going to work until you're 85 or you're going to like die before you're 50.
One of the two. Yes.
One of those three. Yes. Okay,
yes.
Look, I mean, because one could make the argument that if you're truly guns a-blazing YOLO, baby, then why not just leverage the hell? But then I'd say, why not just sell your house? And then go move in with a family member, take all that cash, put it into an investment that actually pays dividends, an interest-bearing investment.
Now we're talking.
And then look, just live rent-free with like your sister down in her basement or up in her loft.
Now we're cooking
Never
with
pay
grease.
rent, never pick up after yourself, never buy groceries, and bitch at her when the dinner doesn't taste good. But you sold your house and you cashed out a couple $100,000 and you're trying to make that couple $100,000 last you, what, a year or two? Like, have you not seen those TLC shows about, oh, I won the lottery, now I'm broke? Yeah, that's why you don't, like, use your house and your home as an ATM.
Damn.
That's like the what not to do.
What happens if I do that and I spend all the money, someone's going to take back my house?
You end up on VH1 behind the scenes. Like, yes, look, no one's going to take your house as long as you make the payments on time. Like, you make the payments on time and you're not conducting illegal activity.
Yeah.
I highly doubt anyone's ever going to ask you to like give me your house back. I'm foreclosing.
Okay.
Right, but if you stop making your payments because you ain't got no job,
right,
and you can't pay your bills, then at some point, yes, you will get foreclosed upon.
Damn.
Yeah. So that's not what today's episode
I know,
is.
but
That is what not to do.
That's you start what not to do because that's how we raise our children. You tell them what not to do first.
And you know what? I say reading. I'm listening
to
Carnegie's How to Win Friends and Influence People. And two things I've learned. My whole life I called it how to win friends and influence others, when really it's influence people.
Oh,
that's
shit.
The proper name. That's the proper name.
Yeah.
And that shit was written 100 years ago.
Still relevant.
It's still relevant, but at the same time, it's almost at this point like a historical piece. So I love the fact that his analogies are like Rockefeller, Taft, Lincoln, Dillinger.
Those are his sources that he's like President Lincoln said at the address.
Yes.
Oh my God.
Yes, but like I'm probably in chapter 2 or chapter 3. I bought it this morning. During my cycle session, that's what I was listening to. And no, man, like anything, it just reminded me what a terrible parent I was, like the first, 16 years of my son's life.
That's fine.
Because I didn't necessarily know how to influence people, right? I didn't know how to make friends.
You don't need. Not your. You know what my dad always said?
What?
I'm not your friend. I'm your father.
You're correct. That's what my dad said to me too. It's funny. He said that to me too. But at the same time, I think there's a way to get people to do what you want them to do without being negative,
right?
Without being so
demonstrative, meaning demanding.
Yeah, I mean, I'm just critical, right? Like you kind of attract more bees with honey. Yeah. So, we're going to talk that way about how people can leverage their HELOCs and their HELOANs. Is like we're going to talk to it in a positive manner. We're not going to browbeat. Right. We're not going to judge, because there's a lot of strategy put behind this. And our originators, they need to be originating these products, not because they're going to make you rich. Like they need to be originating these products because at your core, you should have been creating clients for life. And right now, your clients need you. Right? That's where I really want to probably kick this show off, is like, think about this. There's $35 trillion in home equity. There's $1.2 trillion in credit card debt.
Hold on. Say that number again.
Yep. There's $35 trillion in home equity.
Okay.
There's $1.2 trillion in credit card debt. Now, a lot of that home equity, those people have no debt, right? Because they may own their homes free and clear. Think of a boomer who's 70, who, worked their 45, 50 years. They have their pension. They saved well. They paid off their debt, right? They didn't go YOLO with their home equity.
Right.
And so that's included in that 35 trillion. And what's included in the 1.2 trillion of credit card debt are people who don't own homes, right? 35% of the American populace do not own a home. So that's not necessarily a bad thing, right? I would like to believe that home ownership's in the cards for everyone, right? There is a way to yes, but for some people, it's like we need to create that path first and come up with the how do we do this? And sometimes the how is too big. That hurdle is too high, or it requires change that people don't want to do. Right? Change could be go work a second job for 3 years. People are like, no, thank you. Right? I mean, change would be, hey, instead of living in California, go live in Indiana.
Sorry, what's behind door number 3, Alex?
Yeah, okay, yeah. Continue doing what you're doing, at which point they say, you know what? I like to bitch and complain, but life's not that bad.
Right.
And that's usually the way it goes. I was texting with my old business partner this morning, and I literally, he's like, oh, yeah, well, I hope you guys are doing well. And I was checking on him. He was checking in on me. And I basically, said something on the lines of, things are great. Work is work, and we're having fun.
Right.
Like, I'm sure I could sit back and bitch about, something that is broke at my house, or my kid acted a certain way, or, work was harder than I thought it was going to be. But I'm like, nah, I'm having fun. And my perspective is there. I think a lot of people who may want to own a house, when we lay out that path of here's how you get there, they're like, yeah, no, thank you.
Yeah, no.
Yep. So, but I want our loan originators who tune in, our mortgage brokers who tune in, like we need to understand how to leverage HELOCs and HELOANs. To the homeowners or the home buyers, y'all need to know what are these products and how can you leverage them for your benefit. And even the real estate agents and the financial advisors who are tuning in, like they need to know what are these products, how do we use them for the good to help make things happen. And that's what today's show is going to be about. And the timing couldn't be better because not only is credit card debt at an all-time high. Now, by the way, it's not an all-time high in a dollar amount. If I were to play devil's advocate, is it at an all-time high in terms of average household income compared to credit card debt? Because as a percentage of income, it may be low, right? But the dollar amount of credit card debt's an all-time high. And I will tell you, just kind of following the what's going on in your backyard, like go test the temperature of the room. I would tell you most people that I know aren't overly excited about their careers. They're not overly excited about where they sit with their investments, and they're not overly excited about the lack of expendable income that they may or may not be having. So consumer confidence, we're recording this, here it is March 2025. Consumer confidence is also at the lowest it's been in years right now. So all of this doesn't bode well for the American consumer, right? Credit card debt going up, consumer confidence going down, but we are sitting on record amounts of equity. What can we be doing with this? What should loan originators be doing with this? That's today's episode.
Good job, Dustin.
You cool with that?
I'm great with it.
All right. So first and foremost, I will tell y'all, anyone tuning in, where did I go when I needed a home equity loan? Personally, I went to my bank and I went to a credit union. But what I've learned is banks and credit unions are not as aggressive with home equity lending as they once were. And although they may have some attractive interest rates, they don't necessarily have the most attractive qualifications, and they might not be as aggressive with the maximum, what we call combined loan to value. And combined loan to value is simply this. Your house is currently worth X, John, and let's say for you it's worth $500,000. And let's just assume you owed $200,000 on your home. Mm-hmm. So you have a tremendous amount of equity. You have $300,000 of equity in that home. Your current loan to value is 40%, meaning you owe 40% of what your home is worth. So if you wanted to go get a $200,000 equity loan, because maybe you don't want to touch your first mortgage, that's at 3%. You're going to go get a $200,000 equity loan. What we have to now understand is now you have what's called a combined loan to value. When I combine your first mortgage with your home equity loan, you now owe $400,000. That means you're at an 80% loan to value. 80% combined loan to value is deemed, I would say, pretty average. It's not overly risky. You'd find a lot of banks and credit unions that would be cool with that, as long as your credit score was excellent and as long as your debt to income ratio was low, right? They would have a more restrictive credit box. But let's say you owed $300,000, and let's say you were trying to take out $150,000 on your home equity loan. Now your combined loan to value is at 90%, meaning your house is still worth $500,000, but now you owe, between your first mortgage and your home equity loan, you owe $450,000. There's gonna be some banks that are like, not me. Sorry about your luck. I don't want to do this. So it's because of that when we originate, and this is us here at Lower, it's my friends at Waterstone, my friends at Rate, at Movement, etc., across the board, right? We all turn to our investors, who are typically companies like Spring EQ, or there's this company Figure that does an amazing job, but I think I heard Figure sells the bulk of their loans to Spring EQ. So I think they have a pretty brother-sisterly relationship, or even this company Symmetry, right? And we, as your lender, we have the ability to facilitate transactions just like banks and credit unions did, okay? So that tells the consumer, the same guy or girl who did your mortgage originally, that person, if they did a good job, should have wanted to become your lender for life. This is who you should call if you're contemplating taking money out of your house. And then you have to ask yourself, why are you taking money out of your house? Well, I'll speak from personal experience. I took money out of my house because I was paying my wife's car payment, which was $400 a month, my car payment, which was $500 a month. Because I had gone into business for myself, there was a 2-year period of time where I didn't make enough money to cover my bills. Therefore, my credit card debt went from $0 to $12,000. And I didn't have what most financial advisors would coach me to have, which is 6 months reserves, right? 6 months of my lifestyle in reserve. I was able, because I bought a house for $170,000, because it had gone up in value to $300,000, I was able to go take out a home equity line of credit where I paid off the credit card, paid off her car loan, paid off my car loan, and we ended up having about $18,000. So it wasn't quite 6 months reserve, but it was between 3 and 4 months, $18,000 into a savings account, so that the next time life threw me a curveball, I didn't have to go to a credit card to pay for the AC repair, or to get her car fixed, or to cover the $2,000 copay because we had to run one of our kids to the hospital because she fell down the stairs and bumped her head. All of a sudden, I was so much more financially set. And all that happened is I exchanged $400 a month in credit card payments, which, by the way, I would have never gotten that credit card paid off at $400 a month. $900 a month in car payments, that's $1,300. I exchanged that for an extra $300 a month on a second mortgage, which that's what a HELOC or a HELOAN is. It's a second mortgage, right? It's still a mortgage, which means it's a legal document that's attached to a promise to repay that is then attached to your property. But like, how life-changing was that for me, my wife, our 2-year-old, and our soon-to-be baby on the way, that we freed up $900 a month of outgoing expenses. We put 18 grand in a savings account. Like, do you know how good we slept? Do you know how less we fought because we weren't stressed out about money? Like, that was amazing. And I was able to do so because I made it a priority to purchase a home, and the market worked in my favor, obviously. But the market has worked into all of our favors over the past almost 100 years, like every year, but something like 6 or 8, right? There's only been 6 or like 8 years where the market has either gone flat or it's gone down. And even when it went down, it rebounded within 4 or 5 years. So even that, as long as you weren't having to sell right away, you're in good shape.
Have you ever had a situation where you had a past client that you've worked with that's like, oh, I want to move, but then instead of like moving, you talked them off the ledge and said, hey, instead of moving into like a bigger house, why don't you just take out a HELOC and like build like a playroom or something? Does that happen?
That happens. Yeah, that definitely happens. But probably rarely.
Okay.
Right? Usually because people want to move because they want to be in a different neighborhood. They want to be in a different zip code. They want to be in a different school zone. Or their employers mandating that they move, at which point they have to. But yes, there are plenty of times where the answer isn't move. Like, I love my house. I love my neighborhood. But I want an addition. I want to remodel. I want to renovate. And they have renovation loans that do that. But again, if you're locked in at a 3 or 3.5% rate and the rate on a renovation loan is 8%, why not just go ahead and access $90,000 or $120,000? Like, by the way, the rate on that HELOC or HELOAN, it's not going to be 3%. It's going to be 8 to 12% more than likely.
Whoa.
Yeah, but you look at what you call your blended rate. If you have a few $100,000 locked in at 3.5, and you have a couple $100,000 locked in at even 12, your blended rate is probably much closer to 5.5 or 6 versus trying to get a brand new loan at 7 or 7.5. That doesn't make any sense. And a lot of people, they'll look at their HELOC or their HELOAN as sometimes something that they'll pay that thing down or pay it off quicker than they would their first mortgage. Maybe they're due a big quarterly bonus, they're due a raise, they get profit shared from their employer, they own their own company, and there's certain cycles of owning their own company where they get cash windfalls. They may knock it out. Like, we did this for a good buddy of mine. So a good buddy of mine, his business is taking off, like absolutely crushing. And Kevin Murphy helped him do this because Kevin's our guy. Kevin's the guy who took over my book of business. So you're one of my friends. You're calling in. More than likely, I'm going to say, hey, you need to talk to Murph. And he called in. He's like, look, I don't want to sell my house. I love it. It's going to be a great rental property for me. And my home was worth $600,000. I only owe $150 on it. He's upgrading. Told you his business taking off. He's buying a house for like $1.5 million. Well, when you're buying a house for $1.5 million, you got to put money down. You're not, unless you're a veteran and you're using your VA benefits, like, you got to put 10, 15, 20% down on that. And my dude was looking at his overall financial picture, and he's like, well, I don't want to liquidate that asset, and I don't want to, distribute those funds from my company just yet. Like, what can I do? And Murph's like, look, let's do this. I can go and get you a home equity loan through a partnership, and Kevin used Figure at the time. Today, he may use Spring EQ or he may check with Symmetry, but during the time, he used Figure. Took him like 7 or 10 days to do this. And my buddy was able to pull $200,000 out of his current home that he's going to eventually move out of. And he used that $200,000 plus he used the $100,000 that he had saved to go ahead and put 20% down on that $1.5 million purchase. So all he was doing is leveraging equity from one house into the next. And that's something I love to see people do. Like, we have someone right now who's buying a second home. They're buying a second home, and they have $100,000 to put down. The second home's probably a $400,000 property. Instead of me coming in, it's not me, it's one of my loan officers. Instead of one of my loan officers coming in and trying to do a second loan at 8% or a second loan at 7.5% on a 30-year fixed, what this person did is just took out a $300,000 home equity line of credit at 8%, and they used that to quote unquote pay cash for their vacation property. Now it's not cash, right? They're just leveraging equity from one property into the next. Just like you said, we can leverage the equity to do home repairs, remodels, and additions. You can use it to transfer it from one purchase to the next, whether it's my buddy Rob doing it the way that he did it, or whether it's this particular person who's buying their vacation home, and instead of getting a true loan on that, they just leverage their equity out of their primary home because they had enough of it sitting there. So these are all ways that we as originators can and should be reaching out to our clients, our borrowers, our customers, and letting them know that we're here for them. We are solution providers. The last thing we want them to do is go out on their own and try to figure it out, because here's what I want. I want that guy or girl who came to me for a HELOAN or a HELOC because consumer confidence is down, because they have a boatload of equity, and because maybe they're a lot like me at some point in my life where I had a bunch of cleaning up to do, and the best decision I made was buy a house, and me leveraging some of this equity, aka wealth, to clean up my financial picture was going to help me sleep better at night. It was going to help me argue less with my spouse, and it would help me get on a path of eventual financial freedom.
Life-changing.
I would rather do that today, even if the rate's 8 or 10 or 12%, and eventually, when mortgage rates do start coming down from the 7s and the 6s into the 5s, at that point, you know what I can always do?
I'll refi your ass out.
Correct. Now it'll make sense because everything's about the blended rate, right? It didn't make sense for me to do a cash out refi for this particular person today because the blended rate would have been too high. But once I can get that blended rate down, or I'm sorry, because the new rate would have been higher than the blended rate. But once the new rate is lower than the blended rate, then by all means, it's a lot easier. If someone's paying 3% on a first, 9% on a second, and the first is at $300,000, the second's at $200,000. Again, I don't have my HP 12C in front of me, but let's just say like that blended rate would have been somewhere in the 5.75 range. It doesn't make sense to give them a new loan at 6.5. But if I can give them a new loan at 5.5, well, 5.5 is lower than their blended rate of 5.75. This makes sense. And now it's all locked into one, because something people have to understand, HELOCs, that LOC that we talk about, HELOC, home equity, it's a line of credit. That line of credit the interest rate will vary based typically on prime, whatever prime is doing. Where a HELOAN, home equity loan, is typically more like a fixed payment. There's no ability to draw any more equity. The interest rate could very well be locked in. Sometimes it's a 30-year payment. Not always is it a 30-year payment and it's a 30-year loan. Sometimes it's a 30-year payment with a balloon at 10 or 20 years. That's geeking out. I don't want to go down that path today. But do a HELOC or a HELOAN today. Help change someone's life today. Help them sleep better at night today. And then invite them to come back to you next year or in 2 years to consolidate both the first and the second into a new loan. Like, I think that's what originators today need to be doing. And know this, you're not doing the HELOC and the HELOAN to make a pile of money. These typically aren't big revenue generators. These typically don't pay great commissions. They're small loan sizes. But it's about serving your client. It's about being that lender for life. And this is what all of us should be doing. I would never tell someone, you need to go specialize in HELOCs and HELOANs. No. You need to be offering HELOCs and HELOANs to your circle of influence, your past clients, the communities you serve, regardless if you're making a decent commission on it or not. What you're doing is you're setting the tone for future business. As our buddy Amir says, you're playing a game of chess when everyone else is playing a game of checkers. And consumers, y'all need to know that this exists. Like, y'all need to know that HELOCs and HELOANs exist, just like all lending. The lending requirements are more flexible when it's your primary home. The lending requirements are easier when you have a high credit score, when you have low combined loan to value, but it doesn't mean that you can't take out a home equity loan or home equity line of credit on your vacation property, or that you can't take one out on your investment property. But it's a lot harder to find a bank or a lender willing to do it on the investment. A little bit easier to find one to do it on your vacation property. And then obviously if it's your primary, that's when things start to open up. And the lower your combined loan to value, the higher your credit score, typically the better the terms end up being. But I would tell anyone, don't get caught up in the rate. Get caught up in what it's providing you, right? Don't get caught up whether it's 8 or 12%. You're solving a pain. You are allowing yourself to sleep better at night. You're allowing yourself to afford certain things, like sometimes deferred maintenance. Sometimes it's the new vehicle. Sometimes it's braces for junior. Like, you're putting yourself in a position to become better long-term. It's less about rate. It's more about the temporary bridge that you're building to get from point A to point B.
Well said, Dustin.
So that's HELOCs and HELOANs. Right now, I'm going to do a coaching call in a couple hours internally for about 70 loan officers here at Lower. That's one of the benefits that they get because they choose to align with Lower. They get me coaching them every other week, and they get Amir coaching them every other week, and certain can raise their hand and be a part of different cohorts, where we have a cohort right now for producing branch managers where we're coaching them on how to become more effective at recruiting. And then I'm also coaching a cohort on how to effectively and consistently generate 30 leads a month, right? So these are all things that we're doing. So I'm going to be teaching this in about 2 hours. And I'm like, well, look, if I'm going to teach this to 70 loan originators, why shouldn't I put it out there for 7,000 people to benefit from? And it's extremely topical. So, hopefully someone learned a thing or two. And then here's one last bonus. We talked a lot. Well, I talked a lot.
Yes, you did.
I talked a lot about after you owned the home. Please know this. You can use a home equity loan to purchase a property. And here's my favorite way to do it. I call it the jumbo buster. So in many cases, jumbo financing is not as aggressive as conventional financing in terms of interest rate and qualifications. Well, what if John Coleman is wanting to buy $1 million house? And what if John Coleman could put down 20%? And it'd be a little bit more than 20%, but it would be in your case, if I do the math really quick. No, it'd be 25. And that would allow you to get your loan size below $108,000 and below $806,000. And with your loan size being below 806, then I knew that you're going to be a conforming loan size, at which point qualifications may be a little bit looser and rate and term will be a little bit more aggressive. What if you're like, but bro, if I do that, like if I put down that $196,000 that you're requiring me to put down, or $195,000, like I won't have money left over in my reserve. I won't have money to make the home my own. I won't have money to decorate it the way that my wife wants me to decorate it. I could say, John, you know what? What if you go ahead and on that $1 million purchase, go ahead and just put down $101,000, and then let me give you a second mortgage for what's going to end up being, roughly $90,000. No, 90. I'm going to try to tell you about my math really quick. You're putting down 100. That's 9. Yeah, I'm going to give you a second mortgage for like $95,000. And then now all of a sudden you have a first mortgage, a second mortgage. You put down $100,000, and you kept that extra money that I was going to make you put down, that extra $95,000 you now have to make the house your own. So we use second mortgages, aka HELOANs, or even sometimes HELOCs, on the purchase side to help someone bridge the gap of having enough funds to do everything they want to do, right? So it's a combo loan, and there are a lot of second mortgage lenders, companies like Symmetry, Figure, Spring EQ, that'll partner with mortgage companies throughout the country and allow me to do the first mortgage, let them do the second mortgage, and instead of you having to put the full 20% down, you can put 10% down. Or instead of you having to have the bulk of your loan as a jumbo loan, which could impact your pricing, we could put the bulk of your loan in that $800,000 or below bucket, which makes it a conforming loan, and then leverage using a HELOAN or a HELOC as a bridge between the purchase price, the $800,000 conforming conventional loan, and what you put down, and then whatever's left goes on that HELOC or HELOAN. So that's another way people can get super creative. And obviously reach out to these companies that I'm mentioning. Reach out to your product desk. Reach out to your investors, your wholesale AEs, and find ways to get creative. And borrowers and realtors, just know all of this exists. And if you have a great lender at your disposal, reach out to them and talk to them about your options. Let's not allow all of this equity to go unused if it can be used for a positive, which is to get someone headed in the right direction, and that right direction is towards financial freedom.
Fascinating stuff, Dustin.
All right, John. Well, hey, I appreciate you allowing me to do this today. You seemed as if you were all in the beginning.
I was, and then I would just much rather take out the money and blow it on shit I don't need.
Yeah, and keep doing that. Like that,
I will. That's why I need this to work, Dustin.
Yeah, this is going to be an A/B test. I'm going to do it the way that I coach and teach it. You do the way that you coach and teach it.
Fucking XYZ. That's where I'm into the alphabet. That's where I'll end up.
And then about 40 years, we're going to sit down and we're going to
40.
talk.
You think I'll make it 40 more years?
Yeah, you're young. You're healthy. Yeah, you got this, John.
Thanks, man.
You got this. But for everyone else who tuned in, thanks for letting us geek out today. Not every episode is as geeky as this one, but we had fun with it. It was relevant. And I hope if you're an originator, you can use this content to share with your realtors and share with your communities, your clients, and your borrowers that you serve. And then I hope you learned a thing or two as well. And if you like this type of content, please know sharing is caring. Make sure you share this with not one, not two, but 3 people who would benefit from today's episode. Follow me on LinkedIn. First name Dustin, last name Owen. I am highly accessible. If you have questions, you can reach out to me on LinkedIn. On Instagram, we are at the Loan Officer Podcast. Make sure you give us a follow. Go to our YouTube channel and subscribe. The Loan Officer Podcast, aka TLOP, is the YouTube channel. Hit subscribe. And then lastly, go to our website, tloponline.com, TLOP online.com. It's where you can figure out where I'm going to be speaking live next. It's when our next free masterclass is going to be. It's how you can inquire about booking me to come speak at your event. Or if you have career advice, that is something that we offer pro bono to our listeners and our viewers. You can reach out to us, and myself or one of my team members will hop on a call with you and give you that cool uncle advice. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today. Shout out to Adium. Appreciate you being a show sponsor, and we'll look forward to catching y'all on the next episode. Peace.